Welcome to the weekly update, where I'll go over the action in the market for the week of July 10th through the 14th, and then we'll see how things look for the week of July 17th through the 21st. We had an up week. The markets are looking more positive. We are looking a bit overextended to the upside. Now, one thing we have to be aware of, there's overbought and then there's overextended. Sometimes when we're overbought, that means we're due for a pullback. Other times we might be extended, chop sideways for a little while, and then work that off before we get set to go higher. What we're trying to figure out right now is what is going to happen. Now, we do have some negative things, such as resistance above current prices and other resistance that we've been able to break through. If we start to fall a little bit, is that resistance going to hold? We're looking pretty positive on the daily charts, but short-term overbought, a little bit intermediate-term overbought, and we'll show you some charts in this video that also suggest that maybe we're a little extended, but we still tend to be positive overall. Before I get started, there is a PDF available in the description below this video where I have all the slides and charts that you're seeing right now. You can download that and then follow along as I go through the different charts. There's a condensed version of the daily video. I know a lot of you are very busy. The usual video is about 30 minutes long. Then I do another one where I just take out the main bullet points and a few charts. That usually is about 8, 10, 12 minutes or so. You might find that helpful if you want to keep in touch with things on a day-by-day basis. I do have a private Facebook group that you're welcome to join. And I will be posting a new poll after I get done with this video. I will be going through the results for the poll that just ended. And also, I try to keep a real close tab on YouTube comments. I don't get a lot of comments on the videos, but the ones that I do get, I want them to be legitimate. Even if you disagree with something that I said, or if you're just making a statement, that's fine. I'm just trying to get rid of all the garbage comments, the bot comments, the comments that don't mean anything, the comments that are just silly. Those things, I usually get rid of those. But if you have a comment, even if you're taking me to task, that's fine. I want the First Amendment to be exercised on this YouTube channel. And then I also post videos on Rumble. So just in case you can't find me for some reason, or if you prefer Rumble over YouTube, these videos are also available there as well. So let's go back and talk about what happened. For the week, the S&P was up 2.42%. And volume was below average. We're coming into the summer months now. People are going on vacation. The market's a little indecisive. It's not really screaming to the upside or to the downside. It's just kind of sneaking higher or lower at times. And so folks are a little more apprehensive. So we are seeing volume below average overall. The technicals are positive. We are in a positive environment. Many folks, including myself, think that we have now resumed a new bull market, but that's just a definition. It could switch at any time. We have been in a positive seasonal time for the year, but now we're starting to come into a more weaker time through the middle part of July, through the end of July, possibly even into August. What we're trying to figure out is, will that continue and where are we at right now? That's all we can do. We can speculate down the road all we want. It's like predicting the weather. I can be much more accurate predicting tomorrow's weather today than I can predict what the weather's going to be 6 months from now. That's my view on the stock market. I just take it day by day and then week by week, evaluate the actual information that we see, and then take that, come to a conclusion, and then base things around that. The market continues to be really fixated on inflation and interest rates. We keep an eye on the different geopolitical concern, and then we're starting to come into earnings season again. Our trend is strengthening, and it's positive, so that's looking a little bit better. We're seeing that same thing on the daily charts as well as the weekly charts. Here we are for the week. The Dow was up 2.3%, the Nasdaq up 3.3%, the S&P, which is what is analyzed in this video the most, was up 2.4%, and small caps, led by the Russell 2000, was up 3.6%. They ended up being up the most. So for the week, just some bullet points of what we went through. The S&P had a good week. Volume was below average. But for the Nasdaq, volume was above average. And I hope this type isn't too small to see. On Wednesday, the S&P did close above 4,500. And the current scenario, we're kind of going back and forth. And this can change sometimes almost day by day, depending on the news, depending on what economic reports come out. But the idea right now, as of the time of this recording, is that the economy will avoid a hard landing and that the Fed is close to being done raising interest rates. Be aware, this is about the 12th or 13th time we've been at this point. There have been times almost a year ago where we thought the Fed was going to be finished, the market started going up, then the Fed came out and said, no, we're not finished with that, and that really produced a lot of difficulties in 2022. We're back to the same scenario again, wondering, is it going to play out this way, or are we going to go back and have some more difficult times? The economic data that came out this past week, including CPI and PPI, as well as import and export prices, they show that inflation is declining, and at the same time, employment will remain strong. And that's a lot of the justification that the Fed is using to raise interest rates. Another positive aspect to this last week was that buying was more broad-based. You probably heard it over and over that there's just a few stocks that have really been leading the market higher, and that's true. Now we're starting to see things even out a little bit. It's starting to drift over into other areas, and that produces a more healthy environment. Interest rates did fall on the week, and the dollar actually dropped 2.4% to close under 100 for the first time in quite a while at 99.96. The NASDAQ 100 is being rebalanced, and the close that we had on Friday, that's what they're going to use as the figures to do their rebalancing, and then it will take effect on July 24th. Now, that also affects the S&P 500 because a number of NASDAQ 100 stocks are also included in the S&P. And just as a trivial point, this is the first time that they've done any kind of major rebalancing since May of 2011. The mega cap stocks did start the week going down and really underperforming, but as the week went on, they did get stronger. All 11 sectors for the S&P were up. And earnings season is starting, and we did start to get some reports from large banks. We received earnings reports from JP Morgan Chase, Wells Fargo, and Citigroup. Those were all well received, and United Health also reported this past week. And so now we begin with the earnings season again. On Friday, the market appeared tired, but volume climbed to average. The reason I say that is we were really going up, and a lot of the positive news that came out with earnings, the market could have just skyrocketed. But we're dealing with the idea that we've gone up a little too far, too fast. It looks a little bit exhausted. And even in the face of some good news, the market really didn't move all that much. In fact, we ended up closing down. Now we'll go back and look at the poll results. The first question here is concerning geopolitical events. Do you think the situation between Russia and Ukraine will get better? 17%. Get worse before it gets better? 67%. Get worse and stay worse at 17%. Then I drop down to the left. Lately, there's been a lot of focus on the improvements in the transportation index. And if you watch the daily videos, I'm focusing on that pretty heavily. Do you think this is important or unimportant for the S&P? 60% said it is important, 40% said not important. And we'll see that as we analyze the market. We go through ebbs and flows where one part of the market is having a real impact on the other part of the market. That's why we look at intermarket analysis. And lately, it's been the transportation index that's had a real influence. Now, that could kind of come and go. For the last year and a half, I really didn't focus on the transportation index at all. But now it seems to be coming more into play, and at some point, it might just shift out of focus. Also, the next question, the debate continues concerning a recession. In 2023, do you think we will enter a recession? Half of you said yes, 20% said no, and 30% said yes, but it will be in 2024. Then concerning the S&P 500, do you think we'll hold support and then go higher from there? 36%. Well, we did end up going higher. Or support will not hold and we will end up going lower. 64% said that. Let's go back and look at some Isabel Net blog charts. Now, I'm not going to take the time to go through this. This is the Dow, which is the blue line, and then different Fed funds rates and how it's gone up and down from 1966 to 1977. Although I'm a historian and this is when I was growing up and I think it's very interesting, you might just want to pause this and look at different events that ended up happening. Then we see midterm years tend to see a big bounce off of the lows. Midterm means 2022. We've seen a pretty good run up thus far into 2023, and that's the middle area in here, where we were down 17.5% in the mid-year, and then we bounced up off of that 32.3%. The other area that we're also starting to watch is the pre-election year. That's what we're in right now, where we tend to be down sometimes 11.3%. And then off of that, we are up 16%. Looking at the tech sector with flows, where the lighter blue line, this is money that's going into the tech sector. When we look at the 4-week moving average, it has been coming out, but bouncing back just a little bit. Earnings estimates continue to be optimistic going forward, and that is justifying higher stock prices. Whether it's Morgan Stanley with their projections or the consensus overall, we're seeing pretty much a solid upward move in earnings. Then we look at risk appetite for the next 30 days. Folks are still pretty risk averse right now. And then near-term market performance. They also think that we're going to go into some weakness as far as the market is concerned. Looking at sentiment, this is taking the AAII, which we look at every week, the Investors Intelligence, which is another sentiment gauge, putting them together, and over on the right-hand side, it shows where it is improving and not necessarily at an extreme positive reading. Now, we have the other indicators that we look at that suggest that we are extreme positive right now, but these two together are not really getting to a high level. This could turn in reverse at any time. This is just how are people feeling right now. Inflows into equities has accelerated over the past 7 weeks. Well, when the market starts to do better, people tend to chase what's already happened, and so that's why we're seeing a lot of money going into the market. Then the quarterly year-over-year earnings per share growth relative to consensus. This is kind of interesting, where the expectations actually underperformed what actually happened. The light blue is what they expected to have happen. The dark blue circle is what actually happened, and the performance is actually pretty close. And in all these cases here, the actual performance outdid the expected performance. Now, some of this can be manipulated around a little bit, where analysts may come out and project lower earnings, and then when the company does come out with their report, it's a surprise to the upside, and that really helps boost the stock. As I was looking at this chart, I was surprised at how close these two areas were to each other. Now, I did get the latest reading from current market valuation. This is the historical chart showing that we're above the 1 standard deviation. Then breaking down the different areas of that aggregate score, first we look at the Buffett indicator, which looks at GDP and stock price, where we're above the 1 standard deviation, so we're considered to be overvalued. We're also overvalued with the price to earnings model. We're above the 1 standard deviation. We're fairly valued with our interest rate model because still historically interest rates are low overall, even though they've been going up and really causing havoc in some areas of the economy. They're not at a real extreme level. Then we look at the mean reversion model. This is how far away do we get from the mean or average price of the S&P. This gray line is the historical trend, and when we get too far away from that, then we have a tendency to come back. But this can take a long time to play out. Right now, we're above the 1 standard deviation level. Then looking at our recession indicators, the yield curve, we're very high right now because so many of our yield curves remain inverted. But then more positive, we look at the state coincidence model. The higher this chart goes, the more states are running into problems, and this reading is still quite low overall. We look at market sentiment models that the folks are pessimistic. Now, this wasn't updated since the end of May. This is folks that use margin to get into the market. That's borrowed money. When you're feeling good about the market, you're willing to take more risk. When you're more pessimistic about the market, you're just going to use your own money because then you don't have to pay that back. Then looking at the junk bond spread model, we still remain neutral. We're above the historic trend line and not up to the 1 standard deviation. Now, getting into our charts and analysis. First, we look at the intraday chart. We go back to Monday. Monday was pretty boring. It was pretty much flat. We really didn't do all that much. We did gap higher on Tuesday and ended up closing higher. That was a positive day. We really gapped higher on Wednesday, but then spent a lot of the day drifting lower. We gapped up again on Thursday and then saw some strength going into the close. And then Friday was the down day where we opened higher and then spent the rest of the day coming back down. So for the week, all of the indexes ended up being positive, led by the NASDAQ 100 and the NASDAQ. When we go back to the beginning of the year, the NASDAQ 100 and the NASDAQ are doing the best, with the S&P in third place. Going back to the all-time high, all of the indexes still remain negative because we haven't surpassed that high at least yet. Looking at the sectors for the week, the discretionary sector did the best, followed by communication and tech. These have been the three real winners in 2023 as the market's been recovering. All of the other sectors did end up finishing positive on the week. At the bottom, the real star of 2022 was energy. It was up, but it's not performing like it was back a year ago. Then we look at the relative rotation graph. What's strong? What's getting weaker? We have discretionary, which is XLY. We have XLK, which is tech. These are the strong areas right now. They're green and getting even stronger, where communication had been really strong and it's starting to get weaker. We're seeing some improvement in the financials, as well as the industrials. They're getting into the improving area, where the other areas are still showing some weakness overall. We look at the sectors for the week, and all of the sectors ended up being positive. Going back to the beginning of the year, all of the sectors up until real estate, they are positive, but then the other areas like energy, utilities, healthcare, staples, these are more defensive type plays. They continue to really struggle. Then going back to the all-time high, the only sector that still is positive is energy, but it's given back a lot of its gains. Looking at sentiment, we are extreme positive with the chart that we look at. It's currently at 80, and here's a historical version of that chart where we are starting to get extreme. Now, we tend to ride this wave as it's going one way or the other. We start looking to do the opposite thing when it gets extreme and then begins to start turning down. Looking at the active asset managers, they're pretty optimistic now. Now, some of this data can be a week to 2 weeks old. These are active asset managers. They actually manage money on behalf of other people. They're human beings. They saw the market going up. They had to react to what was happening so that they can say, yeah, I was able to jump on that wave. Well, they're starting to get a little extreme positive. This is another look at that same chart, also showing that we're at 93.34. Usually when we get above 80, that's when we start to take notice. Well, now we're above 90. Looking at the right X bear bull ratio, this is a group that also tends to react to what happens in the market, and folks are getting a little bit more pessimistic, believe it or not. Usually when this ratio goes down, they're more positive. When it's starting to go back up, they're more pessimistic. Then we look at the American Association of Individual Investors. They had got above this 20 level, started to come back down. Now this data is a week old, and we had kind of a difficult week in the previous week, so they're reacting to that. When this still is continuing to go up, and that's why I have the red line on here, we tend to follow that until it gets to a real extreme reading. Looking at the VIX, we were down on the week with the line chart as well as the bar chart, and showing that there's not a lot of fear in the market. The Ulcer Index also suggests that there's not a lot of fear. And then this is another sentiment gauge. We look at how is it if you hold on to cash, or if you take that cash and put it into the tech sector. When this black line is going down, that means the tech sector is outperforming. Well, we ran into some trouble in 2022, where cash was actually outperforming the tech sector as it was going down. Now, into 2023, this black line continues to decline. Looking at the economy, here's the latest reading from GDP Now, where the green line has us up over 2% for GDP. When they ask different economists, they use the top 10 and the bottom 10, and their range is anywhere from about 2% on the upside to actually positive now, up about maybe 0.5% or so on the downside. So we're seeing a shift as economists are seeing the possibility of positive GDP. This is what it looks like on a bar chart where we're focusing on the second quarter of 2023. We're still dealing with the first quarter because this information can lag, but everything is still positive. Then we look at the spread between risky and not as risky bonds. When this ratio is really going up, that means there's a lot of fear in the market and we are concerned. This ratio is actually going down, and there's a real strong inverted correlation between what the S&P is doing and what this indicator is telling us. We also look at the financial conditions index. We only get excited when it goes above the black line. We are actually declining below the black line. This has not been updated for a while. This just shows that the banks are tightening their lending standards. This hasn't been updated since July 7th. The real-time SOM rule recession indicator, we're at the black line. If this goes up to the red line, that's when we start to get nervous. Kind of the same thing with the smooth U.S. recession probabilities. When we get up to the red line, that's when we're concerned. We're barely at the black line. We look at the Brave Butters Kelly Leading Index. This has been going up. It hasn't been updated since the 5th of July, but this is a little bit of a concern, so we're keeping an eye on this. Looking at inflation, we did start a new quarter, so this is showing how inflation is decreasing as economic reports are being released. Keeping an eye on the Fed. As of Friday, there's a 93% chance that they're going to raise interest rates 0.25% or 25 basis points at the meeting coming up on July 26. Now, we still have a little bit of time before that happens, but this is a pretty solid probability for right now. This will change every day, especially as we get other economic reports that are released. This is how it has changed. The dark blue area is where it's at right now. It actually decreased from a day ago, and then we look back a week ago where it's about the same, and then we look back a month ago. So more and more folks are getting into the camp saying that there will be a rate increase at the next meeting. Looking at the Fed balance sheet, it's continuing to decline, just as the Fed said it would. And on a year-over-year basis, we're also showing where the balance sheet is decreasing. Looking at breadth, we're still positive based on price and volume, and we're above the moving averages. Looking at the new highs, new lows, we are seeing a bit of an advance with the new highs. Not enough really to turn our moving average over, but it's showing some improvement. When we go back 10 weeks, we are seeing a longer-term improvement with the new highs. The advanced decline ratio, even though it declined, is still above 0. Accumulation distribution continues to be positive. We're above an advancing moving average. Looking at our trend, the ADX, that's the black line. That's what we use to measure whether we're in a trending environment or a choppy environment. We're above the moving average and going higher. We've crossed above 20. We default to positive because the green line's on top, even though it is declining slightly. If the red line was on top, then we would default to the negative. But for right now, this is looking more positive. The Erin indicator, the green line measures the buyers, the red line, the sellers. After getting extreme positive with our oscillator, which measures the difference between the two, we are seeing a decline, but it's still positive as long as we're above 0. The mass index is not generating a signal right now. Looking at the daily chart, we did break above previous highs. We're looking pretty good right now, but not a lot of conviction is really going on. We might have some upper resistance at this R1 level, which is just about at the point where this upward sloping trend line would also intersect with this resistance level. Then looking at the bottom, you can see where we've been below average with volume. The 50-period simple moving average continues to be positive. Price is above an advancing moving average. Our long-term trend continues to be positive. We're above the monthly pivot point, and we're starting to go up a little bit. We could hit this R1 level, which may provide overhead resistance if we keep going up. We're at the upper side of the midpoint of the trend channel going back to 2009. Our Swenlin trading oscillator advancing based on price and volume, and both are above 0. The PMO continues to be positive. We're also positive based on price and volume. The percent of PMOs that are rising is showing some improvement. We're turning back up with the buy signals, and we're starting to get a little bit extreme with the PMOs that are above 0. Now, you can take this two ways. Number one, that we're getting extreme positive, and that might mean that we're overbought, but as we've been going higher, we're seeing more participation. This measures the percent of PMOs in the S&P 500 that are above 0, and that is increasing. So this is showing more broad-based participation. The McClellan oscillator is above 0 and advancing. The BPI is also giving us kind of an extreme reading. You could take this two ways. We're getting extreme and due for a pullback. Also, we're seeing more stocks participating. The summation index based on price continues to be positive, and we turn back up based on volume. That's also positive overall. The Bollinger Bands is measured by the percent B. We're not getting an extreme positive reading. Our oscillators are all looking better on the weekly chart. We're shifting a little bit on the daily charts and looking a little bit extreme. You could say we're looking a little bit extreme on this as well, but these are arbitrary lines that I put on here just to kind of give us little guideposts as to how we're performing. These things can still go higher than where they're at right now, but so far they're still looking pretty positive. The Chaikin money flow continues to be positive on a weekly basis. We're seeing a little bit of weakness on the daily chart and wondering if this is the smart money selling into strength, since that's what this indicator tries to measure. The Chaikin oscillator longer term, we did decline a little bit, but we're still looking positive. The force index is above 0 and advancing. That's positive. The money flow starting to look extreme positive, which could indicate good momentum or that we're due for a pullback. The rate of change going back 1 week was up because we had an up week. Going back 50 weeks, we did decline just a little bit. And the RSI based on 14 periods were above 50 and advancing. The special K, this is where we're seeing some contradiction. On the daily chart, we've crossed over positive. On this chart, we have crossed over negative. So which one is going to give in first? The Stochk RSI is still extreme positive, suggesting that there's good momentum or that we are becoming overbought. The same thing can be said with the Williams %R. The ultimate oscillator, also extreme positive. The Kopit curve just generated a buy signal on the daily charts a couple days ago. We continue to act off a buy signal with the weekly chart. The vortex, even though it is declining, the green line is still on top. That's positive. It had been giving us an extreme positive reading, so that's being worked off slightly. The ease of movement is showing some improvement. We're above zero and advancing, although longer term, we're pretty much flat after we had been coming back down. Looking at our long-term chart with the Fibonacci retracement levels and longer-term moving averages, we're above all of those right now. Our different charts, the Heiken Ashi weekly chart is positive, as is the Kegi weekly chart, the Renko chart, where with the 3-line break, we're also looking positive. There's nothing new that was drawn into the point and figure chart. We're still working off a signal that was generated on May 15th of an ascending triple top breakout. Our different trading systems, the Heiken Ashi remains positive for the S&P 500, and the dots are underneath with the parabolic SAR system. That is positive as well. The broad market, here we look at the S&P, the mid caps, the small caps have been lagging, even though they had a pretty good week this past week. Where we're seeing some internal strength is in the mid caps, especially when we look at mid cap growth versus mid cap value. The Dow continues to be in an uptrend. The NASDAQ in an uptrend. The NASDAQ 100 in an uptrend. And we actually were able to get above this previous high. Now, can we stay above that? Can we continue to go higher? The next level up would be going back to the all-time high. Mid caps continue to be positive. The NYSE is also positive. Small caps looking more negative. Now, this is where we're seeing some divergences here. When I look at the SML index, we have not crossed over positive on the daily chart. When I look at the Russell 2000 index, we have generated a golden cross. Well, we're still looking negative on this chart, but it is showing some improvement. The Wilshire continues to be positive. All stocks are also in an uptrend. The 30 biggest software companies are positive. FANG, this is another thing we're watching for. We actually broke above the previous all-time high, but we didn't close above that. We got above it and then ended up coming back down. Is this going to offer overhead resistance, or are we going to be able to break through this and keep going higher? ARK also had a good week, up over 11%, where we saw a recent golden cross with the weekly chart. We also generated a recent golden cross on the daily chart. This is another area that I've really been watching, especially the transports, and that's what Dow theory does. We look at the Dow, we look at the transports. I include utilities, which have been under a lot of weakness. We started to really break out above this previous high with the transports, but then on Thursday and Friday we had down days. So it would really help the market if the S&P and the transports were both going up together. That produces a lot more strength. Looking at the bank index, where it was up on the week, we're starting to turn higher with the MACD, and we're still under 50 with the RSI, but we are showing some improvement. We are seeing where folks are putting some money back into the banks. Some broad market measures, commodities, still continue to be in an overall downtrend. Copper chopping around a little bit, but is still in an uptrend on the weekly chart. Oil, after camping out around 70, has been going up. We're at 75.42. Gold did see a pretty good week this past week after seeing some weakness and remains in an overall uptrend. The same thing is true with silver. Looking at the dollar, it did close down below 100. It is in a downtrend. If the dollar continues to fall, that usually will benefit stocks. Where we had a lot of headwinds back in 2022 was strength that we were seeing in the dollar. Looking at bonds and interest rates, the total bond ETF is chopping sideways but is still in an uptrend. Here's a daily chart of the yields where they had been coming down, but then we saw them bounce back up in Friday's session. Here's a weekly chart internationally where the UK has the highest rates followed by the US. Then we have German rates, Keeping an eye on Japanese rates, they're very low for a reason. That could be a possible problem that develops into the future. It's not affecting the U.S. market, at least yet. Stocks continue to outperform bonds on the monthly chart. Then we look at the MOVE index, which measures the volatility of bonds. This is a daily chart. Where bonds were going up, we saw volatility decreasing. The VIX, which measures the volatility of stocks, it also has been decreasing. And the correlation between the two is very strong currently. Then we're looking at the 1-month yield and we subtract the 3-month yield. We should get a negative result, and that's what we're getting right now. A lot of this jockeying around that we saw was around the debt ceiling crisis issue. Some relative studies. This goes back to the beginning of 2022, where oil is still in the lead, followed by the dollar and then gold, where stocks and bonds continue to be negative. Now, if we go back to the beginning of 2023, stocks are in the lead, followed by gold, bonds, and the dollar has now turned negative as it dropped below 100, and oil is leading the way lower. The NASDAQ 100 continues to outperform the S&P 500. They're both doing well, but the NASDAQ 100 is doing even better. The S&P 100 fell back a little bit this past week, but continues to outperform the rest of the S&P 500. Growth is still showing a lot of improvement compared to value. Gold is still in an uptrend compared to the S&P, but we are seeing some weakness. If we see more weakness with this ratio, we may end up seeing a death cross. And bonds continue to underperform stocks. Gold is also underperforming the dollar. We're coming up to this downward sloping trend line, and we've had a hard time being able to break through that. Low volatility stocks, really good in 2022, underperforming in 2023. Energy, doing really well in 2022 compared to tech, now underperforming tech in 2023. Discretionary, really underperformed in 2022 when compared to staples, now outperforming. Then looking at some longer secular, which could be decades, and cyclical trend studies. Cyclical could just be years. First, we look at the NYSE breadth thrust. This signal was generated back in October of 2022. That looks to be when we hit the low, and we've been bouncing up off of that. And this remains on the books indefinitely. It's a longer-term buy signal. Then we had another signal that was generated, the SWAG NYSE breadth thrust, which was generated back in March. And this happens when you have a real low reading and then immediately shoot up to a high reading. This also remains on the books indefinitely. We also have the Zahorchak method. For 2022 and much of 2023, it was negative. Now it has generated a longer-term buy signal. Then this is something new. And what I did is I drew a chart of the weekly S&P 500, and then I had the arithmetic scale. Now, you can be all fancy and say arithmetic, but the word is arithmetic, okay? It's what we learned in school. If we draw a trend line going back to the low in 2009 and we combine it with this low, okay, that looks pretty interesting. And then as we were going up, we actually found that this acted as resistance. Came up a number of times. Anytime we came to this level, we would hit it and start to go back down. Well, back in 2020 and into 2021, we broke through this. And then how is this chart helping us right now? It's really not. We already broke through it and we're far away from this line. What happens if we switch back over to a log scale? And that's what this next chart is. And I only go back to 2018 to keep the chart from being too long. Here's the high that we set in 2018, the high in 2020, right before the COVID plunge, and then extended this trend line. And we're coming right back up to this point. Is this acting as resistance? We tried to peek our head above that this week, but then came back down. Is this going to present some kind of a problem for the market? Are we going to turn and go down from here? The perma bears are just salivating right now, sure, that we're going to fall off a cliff. But there is always the opportunity that we could break above this resistance level and keep going even higher. Just something to be aware of, something that we want to watch play out since this is a longer term chart. We're seeing a similar thing with the NASDAQ 100. This is a weekly chart on a log scale going back to the low set in 2002 where it looked like, okay, this was providing some support, and then as we were going up, it was providing resistance. We broke above it, came back down. Now we're dealing with this again. We're a little bit above it right now. Can we stay above this? Is this going to help the longer term prospects of the market? Then another interesting thing is we look at the NASDAQ 100 and take a ratio of that to the Dow. The NASDAQ 100 are tech stocks, considered to be more speculative. It's why people love those stocks, because you can buy low and sell high, where Dow stocks usually are considered more boring. They're the bluest of the blue chip. They've been around a long time. So folks get into them for more safety reasons, for more consistency. Well, back in 2000, this ratio between the two got to a really high point. This was the dot-com boom. Well, when we finally hit a top, this became the dot-com bust. And it took us over 20 years to get back up to this level. We did hit this in late 2021 when we hit the high, and we've been bouncing back down. Now we're starting to come back up. Is this going to provide some kind of resistance to the market? Now, some folks think we've already hit that resistance and we might start to come back down. But again, we want to keep an eye on this to see how it plays out. Then we look at the weekly chart of the S&P on the top and the German DAX weekly. Their relationship is actually falling off just a little bit, where the DAX is coming off of an all-time high. So this isn't really giving us a lot of insight right now. Our historical and momentum studies, we go back to 1998 through 2004, where it looked like we broke out above the trend line 2 times only to fail. Well, if you look at what the MACD was doing at the time of the breakout, it was not positive in confirming that breakout. We saw the same thing in 2007 through 2010, where it looked like we broke out above this trend line, but the MACD was flat. Well, how is that different from this time? Well, when we broke out above the trend line, the MACD was actually above 0 and advancing, and it continues to go up. So this is looking more positive. So what's the outlook for the upcoming week? Here is the economic calendar. The important ones will be retail sales on Tuesday, and we're going to be getting the LEI on Thursday. Please note that there's no economic reports on Friday. Here's the updated speak schedule for the Fed. Both speeches will be on Tuesday, and they'll be happening at the same time. The Stock Traders Almanac statistics, which only applies to Monday, July 17th. We tend to be neutral to positive with the Dow. We're negative with the S&P, and neutral to negative with the NASDAQ. We're also coming into the middle part of the month now, where we typically see some strength. After the middle part of the month, we start to see some weakness, and this chart indicates that we may see some weakness going into the latter part of the month, but then we have other charts that suggest we might see some strength. We're also keeping an eye on the NASDAQ. It's coming up into the middle part of July, where it tends to do well historically and then see some weakness. Now, we don't know if it's going to play out like this time. We're just looking at historical data to see what does the market typically do, and now we'll see, is it going to follow that same pattern this year? So our scenarios, this just applies to Monday. We're not going with the down one right now because we're positive with our charts, but we are showing some overbought indications. We're still defaulting to the positive, even though we are slightly overbought. In the short term, we're quite overbought right now. We're not going with the sideways trend right now because the ADX is strengthening. It's above its moving average, and both of them are above 20. And the green line is declining slightly with the down day that we saw on Friday. So our warning signs, the longer term trend signals, those weekly charts that I showed you, that could signal that we're at a top right now. We're going to have to see if we can break through that, or are we going to turn and start to head lower? Our oscillators on the daily charts are still diverging negatively, but they are showing improvement. The VIX is still showing that there's not a lot of fear in the market. We've been watching another chart on the daily videos called the S&P to VIX ratio. That's been really giving us a signal right now, and we're wondering, is that going to be a positive signal or a negative signal? The cumulative new highs and new lows for the NASDAQ continue to show overall weakness. The 3-month yield is above where it was at before the great financial crisis back in 2007. If we start to drop below that level, is that giving us some kind of a warning sign? The S&P growth, even though it's still in an uptrend, is weakening. Earnings season is just beginning now, and that can be positive or negative depending on how the report is received. Some positive signs, the longer-term seasonality, those longer-term charts that I showed you, and those setups, those are still in the background. Those NYSE breadth thrust charts that we looked at. The long-term special K on the daily chart is positive, but on the weekly chart, we are negative. The longer-term equity put-call ratio is positive. It's declining, and I know that's counterintuitive, but the more it goes down, the more positive that is for the market. The S&P remains above the downtrend channel upper line. I haven't been showing that chart because we're far away from that line, but we're still above it. We're still in a risk-on posture, meaning folks are favoring stocks over bonds. The Dow transports are showing some improvement, but we didn't see much follow-through in Thursday and Friday this past week. Lower price levels so far have been providing support. Now, we haven't fallen all that far. So if we do start to see a more significant pullback, we'll be watching these different support levels to see if they do continue to hold. The S&P is outperforming utilities, which often gives good support to the S&P. The NASDAQ and NASDAQ 100 have been able to break out above this resistance, and they are positive. Can they stay above those resistance levels? The Staples to S&P 500 ratio continues to decline, which again gives support to the S&P. The small cap index, as measured by the Russell 2000, and the mid caps have generated a recent golden cross. Please be aware that the S&P small cap index has not. Small and mid cap growth continues to be positive, and we're still seeing more of the strength coming from the mid cap growth. The Koppik curve just generated a signal on the daily charts just a couple of days ago. So our conclusion, the S&P remains positive, but possibly overbought. In the short term, we're positive yet overbought. Intermediate term, we're becoming more overbought. We still remain positive in the longer term because we're above the 200-day moving average. But please be aware, this is based on daily charts, not the weekly charts. Then just to end this video, this is put out by Tom Bowley, where this is the month of July, where energy tends to not be very strong, where tech is strong. The first part of July, we're up 25.9%. Then we're starting to get into that middle part of July where we see a decline. The average has been down 13.85%. And then this is suggesting that near the latter part of July, we might see some strength, being up 21.07%. On the bottom, he says, going back 2 decades, the Qs have outperformed the S&P 79% of Julys, and they've outperformed by 1.1%. Thank you. I hope you found this helpful. Please feel free to check out the daily video or the condensed version of the daily video, and I will talk to you in the next video.